Hi, everybody. Thank you for joining us. Welcome to our second iteration of Market Pulse. On the call today, we have myself, Bepin, and Michael Sorrentino on the call with us today. The theme for this week, as some of you might have guessed, the biggest news in financial world was the Fed meeting earlier this week on Wednesday, and that led to a 50 basis point cut, a supersized cut of sorts. And that's the theme you see today, supersize me, rate cut addiction. First, we want to go over some disclosures. This is just some housekeeping, followed by the quote for the week. Everything's bigger in America. We've got the biggest cars, the biggest houses, the biggest companies, the biggest food, and finally, the biggest people. We'd like to make an addition to that. We also seem to have some of the biggest rate cuts. This quote is from the famous movie Supersize Me. I'm assuming most people have seen that, but if you don't know what it's about, a guy named Morgan Spurlock eats McDonald's for every day, and the results aren't great, as you can imagine. So, like we saw on Wednesday, the Fed made one of its larger cuts. It was 50 basis points. These, as you can see on your screen, the circled areas were the last time we've seen 50 basis point cuts. Obviously, as you see, they preceded quite a bit of recessions. The first one being the 2001 dot-com bubble, and the second one there being the '08 financial crisis. As a result of this, markets were a little uneasy. By the end of the day, post announcement, most major indexes were either down or flat on the day. Some of the cause of this fear, obviously, is that why did the Fed cut 50 bips? Now, one of the lines of thinking that some investors have is that if they're cutting by 50 bips and we don't see any data pointing to why they should be cutting by 50 bips, that means they have some data that we don't. They must be looking at something that's telling them that, hey, we need to cut rates and we need to do it quickly. And we can see where they're coming from. If we look at this next slide here, this is showing the first cuts of the previous rate cutting cycles all the way from 1995 to 2024, and showing the forward returns on the S&P 500 over there on the right. And the two that we have circled right there are the last times, like we were talking on the last slide, these are the last two times we've seen 50 basis point rate hikes or rate cuts. And as you can see, the results over the next preceding few years has not been great. I mean, you're looking at double-digit returns and negative returns.
Yeah, I know you say that, Bepin, but we've talked a lot about this. There's a great quote, I think it's from Benjamin Disraeli, there's three types of lies in this world: lies, damn lies, and statistics.
Yes.
And one of the things that I think we need to point out here are that, first and foremost, you're absolutely right. This slide here, this data set is getting a ton of attention right now online and spooking a lot of people. But ultimately, it's two data points. Two. That's it. In the last 25 years. That is not enough to draw a conclusion. And furthermore, look at the dates we're talking about there. I mean, Bepin, you remember 2007 and back in 2001. These are the two worst recessions we've seen in modern history. Okay, exactly. So if you think, if the concern rather is a 50 basis point cut is going to cause this again, then you have to then also think that a 50 basis point cut caused the Great Recession. A 50 basis point cut caused the dot-com bubble to burst. And I'm having a really, really hard time buying that. In fact, I would even argue furthermore, and ultimately we can't prove this, but I do believe that the Fed is extremely intentional these days in how they communicate, okay? I always like to joke around, there are two languages I speak, English and Fed speak. And if you pay attention to the way they've been communicating today relative to maybe 30 years ago in the Greenspan world, they're meticulous. So I find it interesting that they cut by 50 basis points, but they also had one dissenter. One of the Fed governors did not want to cut by 50, wanted to cut by 25. Now, I don't want to sound too conspiracy theorist, Bepin, but I got to think that that was intentionally set as a way for the Fed to communicate, look, we're not panicking, we're not worried. All we're trying to do is to not repeat the same mistake every other Fed has done in the history, at least in modern history, and that is wait too long to cut rates. I truly believe their goal here is to get ahead of this, to get ahead of any type of economic weakness that could potentially happen from keeping rates up this long. And if you look at the next slide here, I think it's more important to drive home exactly what the Fed's goal was to do. Their goal 2.5 years ago was to eliminate inflation or bring down inflation to a target range or close to that target number, which is, they said 2%, but that's a loose 2%. That goal is to bring inflation down there. At the same time, do it without causing unemployment to surge. That was their goal, the quote unquote soft landing. And guess what? They pulled it off. And believe me, I'm one of the biggest critics of the Fed out there. No doubt, but I got to give them credit. They were able to pull this off. Now, there's a lot of debate whether the monetary policy actually did anything, and maybe it was the money supply, blah, blah. It doesn't. And sometimes the ends justify the means, okay? Fact is, inflation is coming down and unemployment hasn't moved. So I think if you look at this compared to other times when they've had to cut by 50, it's not quite the same, okay? We are pretty much at full employment or close to full employment in the economy. I think Powell and the Fed saying, look, let's bring down rates now before we see unemployment get any worse. I also think there's a couple things that are also very important, and actually stuff that Bepin, you and I have talked about over the past several months. If you look at the economy, it's very hard to find any type of signal out there right now that says things are about to get really bad. Now, no question the economy is slowing down. That's almost indisputable. But the analogy I think that we used back a couple of months ago during our State of the Markets was, you think about a restaurant that has a line outside the door. That sounds great, but that's a lot of stress, a lot of demand on that restaurant to produce. All right, and that's where we were a couple of years ago as an economy. Today, that line's gone. All right, that line's been reduced. There's no line out the door, but the restaurant is still full. And I think in many ways that's a more comfortable, easier growth story around an economy than something that's in hyper growth mode. So it's come back down to its long-term average. And if you look at just simple data like the one you're seeing on the screen here, the household net worth relative to disposable income, okay? So basically what that means is how much net worth do I have relative to income coming in the door? It's near an all-time high right now, okay? Compare that to 2001, compare that to 2008, where in 2008, debts were out of control. People owned 3 homes, had no doc mortgages. In 2001, companies that had no revenue had PE rate or valuations on their stocks that were so high that they were mathematically impossible to reach. Like, that stuff's not going on right now. So that's the reason why I truly think that the Fed is trying to do their job for once. And there's some risk at saying that, don't get me wrong, but ultimately I do believe that's what the data is showing right now. And there might just be an ulterior motive, just maybe. We talked a lot about this too. Look, the government debt situation in our country has been interesting the past couple of years. I'll just leave it at that. As it stands today, the interest expense on our debt has exploded, as you see on this chart here. It is on its way to beating out or exceeding what our country spends on defense on an annual basis. These are numbers that are hard to comprehend. We use these numbers to measure distances between stars. This is getting to be a little crazy. Here's a fun fact. About $3 billion a day is spent on interest, paying interest on our debt. $3 billion a day, including weekends.
Oh, that's what I was going to ask. Is that including weekends too? Jeez.
Yeah, it's crazy. So if you think about, let's do some simple math, and Apollo did the math for us. If you reduce all interest rates by 1%, not all, but on average, from like a 3-month interest rate all the way to a 20 or 30-year rate, okay? On average, drop that by 1%. That interest expense goes from $3 billion a day down to $2.5 billion. That's a pretty far drop. I mean, Bepin, I haven't looked at the betting markets lately or what's been priced in the markets, but if I remember correctly, the market anticipates another 70 or 75 basis points cut through the end of this year.
Another 25 in November, another 50 in December is right now.
There you go. I'm not saying it's going to happen. The betting markets sometimes are wrong, but if they get there, yeah, well, they were right. Yeah, look, and we joke around about it, but I think it's safe to say, Beth, and you and I both thought that we would see a 25 basis point cut this week, and we saw 50. It surprised us. I think it surprised a lot of investors, frankly.
Yeah, I did, but some didn't surprise some investors. Obviously, there was, I believe, a 60 some percent chance going into that meeting that the Fed would cut by 50 basis points, and we couldn't wrap our heads around why. Why would we hadn't seen any data that would lead us to believe that a jumbo cut is needed.
Yeah, but look, maybe like I said, maybe the Fed for once is trying to do their jobs and be proactive. So
I think you hit the nail on the head there. I think it is a product of they know where the Fed's gone wrong in the past. And almost every other cycle in the past, the Fed's been wrong by waiting too long. And that's why you've seen some panic rate cuts in the past where, oh boy, the unemployment's skyrocketed and all of a sudden there's an emergency meeting and the Fed has to cut a percentage point off. They're trying to be a little bit more proactive this time is what we think.
And that's that. That's exactly it. So look, we are at the opening ceremonies right now of the Fed Olympics. And it's going to be a very interesting couple months ahead of us. We've obviously got an election coming up, and how the Fed is going to respond and react going forward is up in the air. This 50 basis points is ancient history at this point. And if you look at the sentiment in the markets, it's already shifted to what's going to happen next. So with that, I want to thank everybody for your time. Just know that we will be looking and watching very diligently on the next Fed move, and we will talk to everybody in the next couple of weeks.
Take care, everybody.